What's up? What's up? What's up? My Mind Your Money business folks. It's me yet again with another video on this glorious weekend. Hope you're enjoying your weekend. But I want to come on and talk about something that I find very important and something that I also think that each and every one of you should be aware of. If your intentions are to invest in the stock market, to grow your money, to invest in assets that will grow over time, to make more money, to make money while in your sleep, you will want to hear this. So, as you can see by the title, the stock market will triple by 2030. Now, is that possible? But what I want to do is provide some information that I found from the experts because I am not an expert. I'm just simply someone on YouTube that's providing their opinions and also inform you about the choices that I'm making when it comes to investing in the stock market. I've been investing for the last 4-5 years, and I have made significant gains, in my portfolio. And I wish the same for you. But first, you have to get into the market. Again, I'm not a financial advisor. I'm not a financial planner. I suggest you seek one out in your local area. If you're not willing to do the research to invest your money on your own, because I highly suggest you not just throw your money in the stock market. You need to investigate and also do your own research on these stocks and these companies, these index funds, these exchange traded funds, these mutual funds. Do your research. And you can do this by simply going to the website. You can go to Vanguard's websites. You can go to Fidelity's website. You can go to Apple's website, Nvidia, Microsoft, Broadcom, Tesla. You can go to those companies' websites and pull information and search for information, their earnings reports, their quarterly reports, upcoming events, news, products, so on and so forth, their future plans. You can do your research. That's what I advise you do. Or you can simply find a good index fund, mutual fund, exchange traded fund, and invest your money there where you have professionals managing those funds, where you don't have to be the expert and choose the right individual stock. Because I highly suggest you not invest all of your money into an individual stock. Investing your money into a fund, an exchange traded fund, mutual fund, index fund like the S&P 500, which consists of the 500 largest companies in the U.S., an expert at Fidelity, Vanguard, so on and so forth, Charles Schwab is managing those accounts on your behalf, So again, you do not have to be the expert. But again, the stock market will triple by 2030. And, I just want to provide you with some information because I believe it to be true. Because the stock market was created to grow. Since its creation, it has grown. Even though we've had resets, we've had recessions, after those times, the stock market continued to grow. Rate cuts just happened on September 18th, and they're planning to possibly cut rates 2 more times this year in November and December. Knock on wood, and history has shown us when rates go down, growth stocks rise. More money goes back into the stock market because companies are able to borrow money at a lower rate. Companies need to borrow money in order to grow. People need to borrow money at a lower rate in order to afford their mortgages, to get a nice car payment, so on and so forth. And so by doing so, you put more money back into the economy, which is putting money back into the stock market. Okay? So here it says, Tom Lee raised eyebrows last month, and this article was just posted on September 19th. It says Tom Lee, Fundstrat, Tom Lee raised eyebrows last month when he made an extremely bullish prediction. Bullish means things are going up. Think of a bull. Like when you see a bull, they're always striking up with their horns, right? They're striking up. So when they're talking about bullishness in the stock market, that means things are going up. When they say it's a bearish market, bears do what? Strike down. So that means stock prices and the market's going down. But what Tom Lee has done, he's raised eyebrows because he talks about how the market may become extremely bullish. And he also says the S&P would nearly triple by the year 2030. That's right around the corner, people. I truly believe because of technology and because of our aging population, even those with money are aging out, of life, right? And they're leaving their money behind. But either way, with technology, there's a lot of things moving forward. They're calling this AI boom the fourth, industrial revolution. And a lot of people are not on board investing or aware of what's happening with technology. Okay, in an interview with Bloomberg Odds Live, Lee said he expects the S&P to top 15,000 points by the end of the decade. Currently, the S&P is at 5,700 points, and I believe at the beginning of the year, the S&P was around 4,300, 4,500 points. Now it's at 5,700, and he believes by 2030 it will be 15,000. It will triple, people, which is major. Meaning, if your money is invested in the stock market, say like an S&P 500, a good blue chip growth stock, like say a Microsoft, a Meta, Apple, Amazon, they're adding Planeteer to the S&P 500, I believe on Monday, September 23rd. Either way, if your money is invested into a stock that's growing, that's doing well, you can make a lot of money if you're invested into the stock market. But first, you have to be invested into the stock market. You need to have a Roth IRA, a traditional IRA. You need to have a SEP IRA if you have a business. You need to be enrolled into your, businesses or your company's 401k program. So yeah. And it said the index traded around 5,635 as of mid-September. If this is a normal S&P cycle following demographics, S&P should be potentially 1,500 by the end of the decade. I don't think people understand, or you even understand, what this means. If the stock market triples by 2030, do you know how much money is going to be made by 2030 by those of us that are invested into the stock market? And I highly suggest you invest in the stock market. Do it by dollar cost averaging. You invest a certain amount of money into the stock market every single month. You can do it weekly, monthly, however you choose to do it. Create a budget. Like you should have a budget. I believe in budgets. I am debt free. I have no debt. I have no personal loans, no credit card loans, no student loans. I have no mortgages. I have rental property because my mortgages are paid off. So now my homes that I own are an asset because I am making money off of them. Again, no loans. So I create a budget every month. I have a budget for my rent that I have here. I'm currently living on the island of Guam. I have a job here. I'm not from here, but I work here. I haven't bought a place here, even though I've thought about it, but being debt free for like the last couple years, I'm just not ready to. Either way, back to, I have a budget for my mortgage. I have a budget for my utilities, for my cell phone. I even give myself a certain amount of money each month. I pay myself every month. And I use that money if I want to go out in town to a restaurant or to the store and purchase something. I use cash. I don't just use my credit card. I use cash. I have a budget for monies that I choose to give away every month. I have it written down. I have it on a spreadsheet that I keep. And I track that spreadsheet. I look at it like every other week, sometimes several times a week. But either way, and so that then shows me how much money I have left after everything else is paid out. And then I take a certain amount of that money, or I can take all of it, but currently I don't take all of it. I take a certain amount of that money, which is a huge portion of everything else that's being saved, and I invest it into the stock market. So I suggest you do the same. So if you can only invest $200, then invest your $200, but invest it wisely. If you can invest $500, then invest $500 a month, if that's all you can do. If you want more money, then sometimes you can get a side job. Try to figure out a way to move up in your current job. Get that certificate that you've been pushing off for a while, so you can become certified in a certain skill so that you can make more money. Start that business on the side, that you've always thought about creating, and make extra money that way so you can plug more into the stock market. Because the more that you plug into the stock market, into a good growth stock, mutual fund, exchange traded fund, or index fund, the more money that you will receive back, right? Let's talk about S&P 500. Like I have an S&P 500 ETF, which is SPLG. And I think, let me look here. I can give you an example of what I have made thus far, just year to date, on the S&P 500 ETF. Now, it's currently trading at $67 a share, which is very cheap compared to, its Vanguard equivalent, which is VOO. But let's stick with SPLG. SPLG is SPDR Portfolio S&P 500 ETF, right? $67, and year to date, this ETF has brought back 20.75% returns. So as of January, up until when market closed on Friday, 20.75% return on my money that has been invested into this exchange traded fund. Now, if you're putting all your money that you save after your bills are paid in your, savings or checking account, even your high interest, your high yield savings account, on your checking savings account, you may be getting 1% or 0.1 or 0.275%. On your high yield savings account, you may be getting 4 or 5%. But on this SPLG, I have gotten back 20.75%. Now, it's equivalent, and currently this ETF has in assets about 44.37 billion with a B dollars in assets that's invested into it, right? Which is very good. Now, it's equivalent. Vanguard is like, Vanguard has like trillions of dollars in assets in all of its funds. It's a very popular fund, right? So VOO is equivalent to SPLG. VOO is Vanguard's S&P 500 ETF, but VOO is selling for $523 a share. So $523 a share or $67 a share. I go with $67 a share because I can buy more shares and get more of a return by buying. Say if you only have $500 to invest, why invest it? I mean, you won't even have enough to buy even one share of VOO, but you can buy quite a few shares, at least 7 shares of SPLG, a month. And here's the thing. The year-to-date returns on VOO is the exact same as SPLG, 20.75%, because they're investing into the same companies, the 500 largest companies in the U.S. There are other, Fidelity has an S&P 500 ETF as well. So yeah. So I just wanted to provide that as an example. And you can go to Yahoo Finance to confirm this information as far as how much these exchange traded funds and these stocks cost you. And then also right below it, it shows you the graph of these companies and the year-to-date returns. So again, all of this information is verifiable. That's why you need to do your own research and not just take my word for it. Okay, so back to the article. So Tom Lee said, as you move into longer time frame, that's probably where I think we're moving towards, Lee said, the 15,000 point. That's why I'm into the stock market for the long haul. I'm not in it to make a quick buck and then get out of it next month or next year. I'm investing for the long haul. Long and steady wins the race. That's what Dave Ramsey said. Park your money, keep investing for the long haul, depending upon what age you're at. Me, I plan to invest heavy for the next 10 years, reassess, and then I may not work anymore after that. If I do work, it'll be for myself. But working for someone else, maybe not so much. Who knows? And if I can do it sooner, no, I probably won't do it sooner. But 10 years, right? So you have to come up with your plan. You know, what is your plan? You need to come up with a plan. When you come up with your budget, you also need to come up with a plan. What is your plan for, investing your money into the stock market? Even when you talk to your financial advisor or whomever is going to invest your money, they're probably going to ask you, what is your plan? How much money do you plan to, what is your end goal? Like, how much money do you want to make? When do you plan to pull it out? And then also, when you do pull it out, where will you park it? But that's something that you can talk to your financial advisor, you can talk to your spouse, your family about, something you need to, write down. I always keep a notepad because I write things down all the time. If a thought pops in my head, I write it down. Okay, it also says in the interview, Lee said he was looking at a handful of charts that back up his bullish long-term prediction. Here are the charts, 4 charts shared with Business Insider that show why the already upbeat forecaster is so bullish on the stock market. Number 1, thank you millennials. Millennials' average age is 26.5, still early in their lifetime. Okay, Lee puts the chart above together. It talks about millennials, the cost of things when they buy automobiles, when they start drinking, they're purchasing a home around a certain age, and when they start to make their income, save. So he put together a chart several years ago, but his thesis remains the same. It says the average age of millennials is now around 31 years old, and the global cohort of 2.5 billion people is starting to enter its prime age of 30 to 50 years old. That's where I'm at. This will be the 3rd time the stocks entered a cycle where annual returns compound at high teens. Yeah, at high teens. Like on average, the stock market, I learned, used to bring in returns, 10 to 13%. Now, like last year, it was 20%. Year to date this year, like I just said, the S&P 500 has brought in about 20.75%. So you had the roaring 20s, and then you had the 50s through the late 60s, 1950s, 1960s. And this is a third, he's calling this a third cycle. This is what he told CNBC last month, Tom Lee, the expert. I'm not the expert. Again, I'm just reading their words, And it's up to me if I want to believe what he says. And I truly believe what he says. But you take a chance because everything's a risk. That's why you invest money that you can afford to lose. You save a certain amount. Also, when you create your budget, make sure you have your emergency plan set aside. You have money set aside. I have an emergency fund, and I also have, just money sitting off to the side. So when stock goes down or things start to go down for whatever reason, like it has been, especially like in August, I can take some of that reserve cash and throw into the market, without touching my emergency fund to purchase more shares of stock. So that's what you do, or that's what you can do also when you control your money by creating a budget. I create a budget because I tell my money where to go each week, each month, instead of me trying to figure out where it all went because I have so many bills and I'm in so much debt, right? Okay, so they all coincided with a surge in the numbers of people around ages 30 to 50. So in other words, the number of prime age adults, and this time is powered by millennials and Gen Z. I totally agree because I'm in that 30 to 50, I'm close to 50, right? And I am now looking at investing more of my money. I'm looking at controlling, my life. And so I'm learning more about the stock market, and I'm putting my money there. Lee says it's a demand story. When you get into your prime years, 30 to 50, Urban Institute shows you start to borrow more money. You're making big life decisions. This is what powers the economy. You're buying more cars. You're buying the house. You're buying that that RV. I want an RV one day. You're investing in the stock market. You know, you're heavily investing in your 401k plan. You're getting out of debt. So, and by doing so and purchasing these things, you're boosting the economy. Okay, number 2, it says stock market peaks and demographic. The stock market has a history of peaking right around the same time a population hits its peak prime age of around 50 years old. I think starting next year, man, as they continue to lower interest rates, things are gonna, start going to the moon. But again, as people get around their peak prime age of 50 years old, as they get closer to retirement and often spend less money, I became debt free and I spend less money. So this is so true. I haven't read this article yet. I'm reading it for the very first time. So that's why I'm agreeing with what it says, because it makes sense, because I'm in this age group, and a lot of you that will be listening to this video is also in the same age group, right? If you're around the age of 30 to 50, you're thinking more about saving money. You're trying to figure out how to save more money. You're trying to figure out, what needs to be done to make more money. You're trying to figure out, like, how can you get ahead, because you feel as though you're behind right now. You're behind compared to your peers, even though your peers may look as though they're much farther ahead, but you never know. That's why you should mind your money business. Mind your money business. Mind your business. Don't worry about other people. Don't worry about what they're doing. Just focus on you. Just focus on you for now. And that's why I created this channel, in hopes to find other people that are thinking like me, so that we all can get on one accord and go on this journey and this mission to create a solid foundation for ourselves, right? Okay, for example, when the greatest generation peaked in 1930, that coincided with a multi-year bear market in stocks. So that means things went down, right? Fast forward to 1974, when the silent generation saw its prime age peak. This occurred around the same time as a painful stock market corrected of about 35% that lasted years. Wow. And the peak in the baby boomers population prime age was in 1999, just a year before a multi-year bear market in stocks. The average millennial is not set to hit their prime peak age until 2038, suggesting plenty of upside ahead for the stock market between then and now, according to Lee. So, what I am gathering from this, he said the average millennial is not set to hit their prime peak age until around 2038. So around 2038 is when we can expect maybe a correction or a bearish market. But from now until then, things can possibly be on the up and up. You never know. But that's why you get in the stock market and you see what happens. Number 3, tech will address global labor shortages. Yeah, tech is big time. According to Lee, spending on technology will boom in the coming years as the world grapples with the growing labor shortage. Like, they don't have enough people to do jobs, in certain areas. But technology is going to fix that. Okay, we have a really big opportunity in U.S. technology companies because of AI, NVIDIA, Broadcom, Palantir, Microsoft's getting into it, Intel, all these companies, right, which is supplying the global digital labor because there's a global labor shortage. Like, I've been to, like, the airport in Hawaii, in Burger King, like, there's like a pole where you can go place your order, or you can go to the kiosk, place your order, and you pay for it with your credit card, and then you wait for someone to bring up your food. I've seen videos where there's like bags of food coming down chutes going to people, like they're coming down like a little tube, and then someone picks it up and then calls out the person's number and they get their food. Again, that's because of technology. Okay, so these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns, like an NVIDIA, people. NVIDIA controls about 80% of the AI space. You know, it's a semiconductor technology company. Okay, Lee says, I think that there's going to be a lot of dollars spent on U.S. technology product because the world is short 80 million workers by the end of this decade. The population is on a decline. I don't know if anyone's paying attention, but like in Japan, like they're like abandoned houses because there are no people to live in them. People aren't having babies like they used to. It's happening all over. So because there's going to be a shortage of people, is that by coincidence? Okay, I'm not going to get into any conspiracy theories. But either way, there's going to be a shortage of people. And when there's a shortage of people, the job still needs to be done. So technology is going to do it. So it says here that they're expecting 80 million workers shortage of 80 million workers by the end of the decade. They know this. Here's the thing. The people with money and power, they're light years ahead of us. You know, they're in those rooms making decisions about the plan of the world, countries, you know, decades from now. They're making these plans. We're just living day to day, not paying attention to anything. What is that thing called? The World Economic Forum. Like when these different people get together. Like the World Economic Forum is an international non-government organization, think tank, and lobbying organization. Needs a lot of money. You know, that happens in, Canton of Geneva in Switzerland. Yeah, take place. Read about it if you want to. Either way, I'm not getting into that, but either way, decisions are being made, right? And so they're expecting, again, an 80 million worker shortage by the end of the decade. That's roughly $3 trillion of labor salary that's turning into silicon. So that means U.S. suppliers of silicon and AI are going to have a $3 trillion revenue run rate. So who's going to make that money? Companies are going to make that money. Rather, technology's out there doing the job that people are no longer doing. The companies are still making these products that's being bought by other companies. And if you're invested into the stock market, you're going to make money as well because you're now an investor in that company. Because, you know, like Meta's creating like the metaverse where you'll be able to tap into it virtually via your VR goggles or glasses. And either way, that's another story. Look into it. There's nothing wrong with it because everything is a choice. You make the decision to do whatever it is that you choose to do. Either you choose to invest or you don't. Either you choose to be aware of what's happening or you don't. It's up to you. But don't be surprised if something happens and you don't like what's happening or you don't like the decisions that are being made and how it may affect your pockets or how you may not have enough money to live off of. You made the choice not to invest. You made the choice not to try to figure things out. You made the choice not to learn. You made the choice not to seek financial advice. You made the decision to create more and more debt. So at the end of the day, we have to take responsibilities over our lives, and that's why I created this channel in hopes that that is something that you're willing to do. Number 4, money will flow into U.S. tech stocks. Like, I believe, like, some of these companies, like, currently, what is Apple valued at? Apple is currently valued at, Apple has a market cap of $3.47 trillion. With a T. We spend all of our money on Apple products. Apple has $3 trillion. Apple doesn't need any more money, but hey, this choice is yours. If you're going to buy their product, at least invest in the stock. So when you buy the product, you're buying something that you also own. When you invest into these companies, you own part of it. So when you buy the product, you're also reaping the benefits of owning it as well. You know, again, Apple is the most valued company in the United States at $3.47 trillion. Microsoft is second Microsoft has a market cap of 3.235 trillion with the T. Hey, and they're all buying this AI technology, semiconductors, these chips from the likes of NVIDIA, right? Because they're trying to get ahead. They're trying to be prepared for when the future comes. They have products that can be utilized. Meta is doing the exact same thing. That's how Meta is creating the metaverse, right? This virtual reality that's going to have people locked in for days. You think people are addicted, and these kids are addicted to these video games? Wait until the metaverse gets a hold of them. At least that's just my opinion. It's not a bad thing. Again, it's the choice that the person makes, to get into these things. So, NVIDIA. I believe NVIDIA is the third largest company in the US. And people talk about NVIDIA like it just came out of nowhere. NVIDIA has been around since 1993. It was a gaming company, and because of the creation of its technology, is now the leader in AI. And NVIDIA is currently it has a market cap value of $2.845 trillion. And I believe I started to talk about the market cap on these companies because, like this number 4 says, money will flow into these U.S. tech stocks. And it says as more companies spend trillions of dollars on the technology to address global shortage, that will catapult the technology sector to make up 50% of the S&P 500. There have been days in the stock market where NVIDIA shares have gone down, and it said that one company affected the whole S&P 500. Mutual fund, exchange traded fund, or index fund. Because of that one company going down, it affected the whole entire fund that consists of 500 companies, but that one company. But they're saying the technology company will, make up 50% of the S&P 500. Not all of the 500 companies within the S&P 500 are technology companies. It covers a sector, different sectors within the market or within the U.S., but it just shows technology is driving the future. And I believe that at some point, NVIDIA, Microsoft, Apple, they could be, $6 to $10 trillion companies, market cap of that much. And if they are, and you are invested into those companies, if you're not invested into them, via individual stock, but you're invested into the S&P 500, you're invested into an information technology, ETF like FTEC from Fidelity or BGT from Vanguard, you stand to make a lot of money. Okay, it says the next sentence says the information technology sector currently makes up about 30% of the index. Wow. And so it says if U.S. companies are growing earnings at this speed, the PE multiple, the price and earnings multiple of the U.S. should go up. There is going to be capital flows into the U.S. Where else in the world do you find the best and most important technology company? They're all basically in the U.S. That's why I don't understand why people are still fighting. They're arguing with one another. There's so many things that can be taken advantage of in the U.S., but instead we just fight and argue over things that we can't control, whether it be public figures, our neighbors, another state that we don't even live in, but because they reported on it in the news, we give so much attention to these things and we give less attention to ourselves. Trust me, try and focus just on you for a day, 2 days, and see how hard it is, because everyone is vying for your attention. Even me in this video, I'm vying for your attention, hoping that you will hear me and do your own research, right? But instead, most people, like right now, before I got on live, college football is on. It's Sunday morning here. It's 9:57, but it's Saturday back in the U.S. and college football is on. Like the Michigan game, it may be off by now, but Michigan was playing. Who's Michigan playing? They were down by 3 points. I think. Oh yeah, Michigan's playing USC. Currently, that stadium is filled with over 100,000 people attending that game. And I can only imagine the millions of college football fans that are watching on television. Again, people are focusing, there's nothing wrong with focusing on those things, right? But then the average American it's like 1 in 5 Americans have enough money, to live off of or are ready for retirement. So it's like 1 in 5 of those hundred thousands and millions of people that are watching have nothing set up for retirement. And that's something that I posted on my page as well. Did I? Yeah. 1 in 5 Americans ages 50 plus have no retirement savings, and more than half, 61%, are worried they will not have enough money to support them in retirement. But these people know everything about these football players, these coaches, how many catches they've done, how many have gone into the NFL, what they're doing in the NFL. There's nothing wrong with that. That's why the way that money is being made and the 1% that do control the market, that's why they control it. They're focused on one thing. Like they own the teams. We're paying money to see the teams. So that's what I would hope people will start doing at some point. Taking control of their lives, investing their money. But yeah, I just wanted to come on and share, my thoughts on and belief that the stock market will triple, by 2030. It's a bullish market, people. And that's what happens. The last time the market rates came down was March of 2020. And that first week that the rates came down in March of 2020, the stock market took a dive. And then the following week, it started to go up. And it has been on a climb since March of 2020. It's been on a climb ever since then, even up until now. There's been a few corrections here and there, but a lot of people have taken their money out of the stock market. They placed it, in treasury bonds. They placed it in these high yield money market accounts, so on and so forth. And that money, which is in the trillions of dollars, is going to, at some point, start to trickle its way back into the stock market as these interest rates go down. Because when interest rates go down, good growth stocks start to go up. Because again, these companies are able to borrow money at a cheaper rate, because they have to borrow money at a cheap rate in order to grow. So when they pay back these loans that they're taking out, they're able to keep more money within the company. But if you have high interest rates and you're borrowing money, you may have to start laying people off because you can't afford to pay back these high interest rate loans and pay these people a good salary. So now that rates are coming down, money can be borrowed from businesses or by businesses at a lower rate and people at a lower rate. The housing market is probably about to go through the freaking roof. But right now, I believe inventory is low in the U.S. housing market. So that's probably going to drive the current prices of homes that are being placed on the market up, right? But the higher price is going to be at a lower interest rate, and that's all people are going to see. And so they're going to finance these $1 million homes at like 3%. Yeah. All right. All right, so I'm going to end this video here. Hopefully you guys find the information that I'm putting out on this channel interesting. So like, comment, subscribe, share this video. Let me know what you think. If you think anything at all, mind your money business. Keep your attention to yourselves, people. Invest in yourself. No one is going to invest in you for you. You need to do it on your own, because you will appreciate the reward even more. All right, so you guys take care.